The International Monetary Fund has revised Nigerian economic growth outlook upward, projecting a 3.9% GDP expansion in 2025, a growth that is pegged on higher oil production, stronger investors' confidence, and a more supportive fiscal stance as key drivers. Hello and welcome to Business Point, where we extract the Nigerian economy and the government's policies. I am Kike Lomo Okeri. The update figures contained in the IMF latest economic outlook titled Global Economic Influx Prospects remain dim. It reflects a 0.5% point increase from its previous forecast and signal renewed optimism about the country's medium-term economic prospects. In July, the IMF revised Nigerian economic growth projection for 2025 upward to 3.4%, a 0.4% point increase from the 3.0% forecast published in April 2025 World Economic Outlook. Speaking at the press conference to mark the launch of the report, the chief of the IMF Research Department, Dennis Egan, says the upward revision for 2024 reflects the authority's GDP rebasing, which provides broader coverage of economic activities, including those in the informal sector that were previously underrepresented for 2025 and 2026. The improved outlook reflects reduced uncertainty and the limited impact of the U.S. tariffs on Nigeria. Given its relatively low exposure to those markets, the appreciation of the exchange rate since July, and stronger financial condition due to rise investors' confidence, a supportive fiscal stance, and a higher oil production under improved security condition, which has led to stronger hydrocarbon growth. All these factors together contributed to the upward revision in the Nigerian medium-term growth forecast. While Nigerian growth has been reviewed upward, growth for the sub-Saharan Africa region is expected to remain subdued, unchanged in 2025 from 4.1% in 2024 before picking up to 4.1% in 2026. This is an upward revision relative to April 2025 WEO forecast for cumulative 0.5% point, but downward revision of 0.1% point compared with October 2024 WEO. Whereas growth in Nigeria is revised upward on account of supportive domestic factors, including higher oil production, improved investors' confidence, and a supportive fiscal stance in 2026, and giving it limited exposure to higher U.S. tariff. Many other countries see significant downward revision because of the changing international trade and official aid landscape. The upward review comes on the heel of the Fitch rating affirming Nigeria's long-term foreign currency issuer default rating by B with a stance outlook. Fitch says the Central Bank of Nigeria remained central to the new rating, saying Nigerian B rating is supported by its large economy, a relatively developed and liquid domestic debt market, large oil and gas reserve, and improved monetary and exchange policy framework. In the same week, the global index provider FTSE Russell, in its September 2025 semi-annual country classification, reviewed for equities for fixed income, adding that Nigeria has been added to the watch list. Explaining the addition of the watch list, FTSE Russell says for possible reclassification from unclassified to frontier market status, as the market meets with 5 FTSE quality of the market criteria required for attaining frontier market status. Meanwhile, for the sub-Saharan Africa region, the IMF noted that many low-income countries in the region that have benefited from the preferential access to the U.S. market under the Africa Growth and Opportunity Act, which expired in September, are expected to have sizable negative effects, particularly to Lesotho and Madagascar. On the global stage, the IMF projected growth at 3.2% this year and 3.1% next year. The organization hinged the current global outlook on the agility of the private sector, which front-loaded imports in the first half of the year and speedily reorganized supply chain to redirect trade flows, and the negotiation of trade deals between various countries and US, as well as the overall restraint from the rest of the world, which by and large kept the trading system open. The managing director of the International Monetary Fund, Kristalina Georgieva, says that the world economy has proven more resilient than expected despite multiple shocks. Speaking ahead of the WEO launch, the IMF chief economist Pierre Olivier says global growth is holding steady despite more policy shifts. The increase in the tariff and its effects have been smaller than expected so far, thanks to trade deals, multiple exemptions, and the private sector agility in rerouting supply chain. As a result, global growth is now projected at 3.2% this year and 3.1% next year, only a modest downgrade from last October. Yet, beneath the steady surface, complex forces are at work: easy financial condition and a weaker dollar, fiscal stimulus in some major countries, and surging artificial intelligence investments are all shaping activities and inflation dynamics. Despite a steady first half, the outlook remains fragile and risk remain titled to the downside. The main risk is that tariffs may increase further from renewed and unreserved trade tension, which, coupled with supply chain disruption, which could lower global output by 0.3% next year. Risk remain titled to downside. The AI surge could trigger a sharp market correction if profit expectations do not materialize. Physical pressures are mounting across many countries and may interact with financial market fragility to further rise borrowing costs and increase rollover risk and institutional credibility. Particularly, central bank independence faces growing political pressure that could de-anchor inflation expectation. Still, there are upside risks too: a faster resolution of trade tension and associated reduction in uncertainty, as well as the potential for significant productivity gains from AI, which could all give global growth a meaningful boost. The IMF went on to project that the combined effect of the lower uncertainty, lower tariff, and AI could raise global output by about 1% in the near terms, thus underscoring our policies that help restore confidence and predictability can improve growth prospects, noting that policies should aim to restore confidence and predictability, stabilize trade relations, reduce uncertainty, and rebuild fiscal space credibility. Money policies should remain independent yet transparent and tailored, with a key objective to maintain price stability. Over the long term, economies should invest in innovation, productivity, and multilateral cooperation, empowering private enterprises and favoring horizontal policies like education, infrastructure, and smart regulation over costly sectorial subsidy. The World Bank says access to affordable and reliable electricity could unlock Africa's job creation potential, transform economies, and lift millions out of poverty. In a new blog post titled "Switching on Opportunity: How Electricity Can Transform Jobs in Africa," the bank noted that while energy advances have revolutionized work globally over the past 150 years, Africa progress remains slow, with about 600 million people still lacking access to power. The World Bank warns that an unreliable power supply continues to be a major barrier to growth, with blackouts causing business disruption that reduce employment rate by an estimate of 5 to 14% points. According to the institutions, energy access has become one of the most critical levers for economic transformation and job creation across the continent. It says such sectors such as agribusiness, light manufacturing, mining, construction, healthcare, and tourism could see significant productivity gain through more intensive and reliable power use. To accelerate progress, the lender says it is leveraging $30 billion in resources from its International Development Association over the next 5 years to support Mission 300, an initiative aimed at providing electricity to 3 million Africans by 2030. The funding represents about 20% of its total support to the region. These national energy plans aim to expand infrastructure at competitive cost, integrate regional power markets, attract private investment, and strengthen utility. The World Bank cited examples across continents where electricity expansion is already creating jobs and boosting productivity. In Ethiopia, one project has connected more than 8 million people and over 19,000 schools, clinics, and government facilities. Tanzania Rural Electrification Expansion Program has linked over 16,000 rural businesses to the grid, supporting food processing, fish farming, and construction. Similarly, Senegal Energy Access and Scale Up project aims to electrify 600 healthcare clinics, 200 schools, 700 small and medium-sized enterprises, and 200,000 households, creating jobs through installation, maintenance, and supply chain. In Syria alone, demand-driven grid are proving that rural electrification can be commercialized viable when tied directly to productivity activities such as mining, cold storage, and digital services. The World Bank stated that this engagement reflects broader efforts across the region to transform the energy landscape with practical solutions that do more than just on the lights. They also create jobs at scale. The bank maintained that powering Africa industries, health center, and small businesses is essential to building a stronger, more resilient, and better skilled workforce capable of driving long-term growth. The Intergovernmental G4, popularly called G24, is calling for improved developing economies. The G24 advocates for a comprehensive debt resolution framework and sweeping reform from the international sovereign debt system to help these nations achieve debt sustainability and return to growth. These calls come amid rising global debt level and economic uncertainty. This disproportionately affects emerging markets. These are the key aspects of the G24 call. Overall, the debt framework, the G24 is pushing for fundamental changes to international sovereign debt system to make it more effective for the member countries. Strengthening international support, the group wants more robust international cooperation to assist developing economies which are grappling with debt volatility, financial tightening, and trade uncertainties. Achieve debt sustainability. The ultimate goal is to help member states regain debt sustainability and get back on positive growth trajectory. Comprehensive debt resolution, the G24 emphasized the need for comprehensive and inclusive debt resolution mechanism to manage and restructure sovereign debt credibility and fiscal discipline. They also acknowledge that regaining market access and sustainability requires credible and physical discipline from the debtors nation themselves, which is prerequisite for restructuring or refinancing. Let's take a listen to G24.
We call for broader reforms of the sovereign debt architecture to focus on fiscal sustainability and improving country risk assessments by credit rating agencies. We emphasize the need for institutional mechanisms for crisis prevention and response to support countries with sustainable debt positions that face short-term liquidity shocks.
When we talk about a comprehensive sovereign debt restructuring framework, is a framework that includes not only bilateral creditors, a few bilateral creditors, but that also includes the private sector. The private sector is currently not included. So if a country has a private sector debt, it's not included as part of the common framework. And that also goes with the debt to international financial institutions like the IMF and the World Bank.
Really, from Nigeria's perspective, frankly, less of a problem for us. And I think we were very fortunate because a lot of the things that were needed to have been done, we did them much earlier. And as a result of that, we were able to create resilience and buffers against potential shocks. So, and of course, in terms of anchoring expectations, we found that those who followed the Nigerian economy were fairly comfortable. And for us, again, oil is basically the only commodity that was so exposed, and the impact on that was relatively modest.
We call for broader reforms of the sovereign debt architecture to focus on fiscal sustainability.
The G24 message is simple. The world must move from sympathy to support, ensuring that developing nations are not left behind in the global recovery. One thing remains clear: developing economies cannot thrive on promises alone. What they need now is decisive, coordinated action and genuine international support to break free from the cycle of debt and chart a sustainable path towards growth. Let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you just join us, it's Business Points, where we extract the Nigerian economy and the government policies. The Nigerian Infrastructure Debt Fund has reported a profit after tax of 16.87 billion naira for the 9 months ended September 30, 2025, representing a 23% increase from the 13.69 billion naira recorded in the corresponding period 2024. According to the quarterly investors report on the Nigerian Exchange Limited, the fund total income rose to 18.45 billion naira during the period under review, compared to 15.14 billion naira posted in the same period last year. The growth was largely driven by higher interest income on infrastructure loans, which increased to 16.68 billion naira from 12.64 billion naira in previous year. NDI, which is Hill Denham, maintained a diversified portfolio of 29 investments as of September 30, 2025, with a weighted average annualized yield of 22.59%. The report shows that the fund continued to outperform its benchmark, the 10-year federal government bond, with most loans priced at 300 to 500 basis points above the benchmark on the floating rate basis. During the third quarter, the fund successfully concluded fundraising for its Series 11 issue, raising 15.2 billion naira in the net proceeds. The Securities and Exchange Commission granted allotment approval for the new unit on October 3, 2025, in line with its consistent distribution policy. NIDF declared a quarterly payout of 4.25 per unit for the third quarter ended September 30, 2025. The qualification date for the distribution is October 27, while the payment to eligible unit holder is scheduled for November 4, 2025. As of the end of September, the fund net asset value stood at 129 billion naira, while the net asset value per unit was 108.36 billion naira. The NIDF market value was 135.16 billion naira, with its last traded unit pricing closing at 113 naira on the Nigerian exchange and the FMDQ exchange. The naira opened the week on a mild depreciation, trading at 1,467 naira to a dollar on Tuesday, slightly weaker than 1,460 naira to a dollar. It closed on Monday. This is according to the data tracked on the Central Bank of Nigeria website. The currency closed at 1,458 naira to a dollar on Friday, recording its best performance since 2024 as the Central Bank of Nigeria intensified efforts to stabilize the foreign exchange market and sustain recent monetary gains. The CBN data shows that the naira began last week at 1,464 naira to a dollar on Monday before depreciating slightly to 1,472 naira to a dollar on Tuesday. At the parallel market, the naira traded at 1,498 naira and 1,504 naira to a dollar. However, Nigerian foreign reserve rose to $42.6 billion, up from $42.5 billion recorded on Monday. According to Central Bank of Nigeria, this marks a steady upward trend since July 14, 2025, reflecting improved inflow from oil exports. Analysts believe this consistent growth in reserve will enhance the CBN's ability to stabilize the naira and manage speculative pressure in the currency market. In its latest outlook, Standard Bank revised its foreign exchange forecast, stating while the risk remain evident, now as at year-end FX forecast, we see that at 1,458 naira against USD by the year-end, and 1,473 naira by December 2026. A quick look at the inflation shows that inflation outlook remains positive for September despite the naira's slight depreciation. Nigeria's inflation rate is projected to continue its downward trend in September 2025, with analysts linking the expected moderation to a firmer exchange rate, improved food supply, and stable energy price. According to research, since stability in the exchange rate and the energy market was maintained, September could mark the sixth consecutive month of easing inflation. The National Bureau of Statistics reports that the Nigerian headline inflation rate eased for the fifth consecutive month, dropping to 20.12% in August 2025 from 21.88% recorded in July 2025. This means, according to NBS, that August 2025, the rate of the increase in the average price level was lower than the rate of increase in the average price level in July. The International Monetary Fund says the depreciation of naira was not necessarily a bad thing. The financial counselor and the director of monetary markets Capital Markets of the fund, Tobia Adre, stated this while fielding question at the Global Fiscal Sustainability Report press briefing at the ongoing annual meeting of the World Bank and the IMF in Washington, D.C., USA. Asked what policy measures the fund could advise the Nigerian to adopt to shore up the value of Naira that has suffered a major devaluation in the last 2 years. The director says in terms of the Nigerian economy, exchange rates are important buffers to adjust the domestic economy relative to shock. He says while growth has been pretty strong during this period where financial conditions are easy, capital flow are resuming, it is also possible that the previous capital flow surge and retreatment cycle that have been seen before it could happen, and when it happened, it could expose some of these economies with vulnerability, particularly when foreign investment were retraced. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms as Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.